Hello and welcome to this special webinar from Fat Profits. My name is Roger Malik. I am the Head of Client Services in our Sydney office and the host for today's webinar. And we've titled the webinar today, Stormy Waters. As most of you are aware, we're running through some volatile times, and the purpose of this webinar is to run you through a plan on how to navigate through these stormy waters and find ourselves coming out dry on the other side of this when everything has settled. So please stay tuned. And joining me today is firstly our Senior Account Manager, Cheyenne Chant. Cheyenne, welcome to the webinar. How are you today?
Good, thanks for having me. Hello, everyone.
Excellent, good to have you on board. Well, Cheyenne, you've been with the Fat Profits business for how long?
Just over 12 years now, Roger. So I'm just like an old furniture now here at Fat Profits.
I wouldn't say old, but yeah, pretty good-looking furniture. So welcome to the webinar. I'm sure a lot of members can relate to you who've been speaking to you over the years. So it'll be good for them to hear from you today, and we'll get some input. And also joining us today is our account manager, Ashna, or as we love to call her, Ash. So Ash, welcome to the webinar. How are you today?
Thank you, Roger. Well, thank you, and hi, everyone. It's good to finally join you guys in the webinar today.
Excellent, and I'm sure a lot of members can probably relate to your voice as well. You've been helping them over the last 2 or 3 years as well. So before we get into the webinar, let's do a quick bit of housekeeping. All our presentations from Fat Profits are general in nature. We don't provide any personal advice. If you are looking for that, please see your financial advisor, and also past performance is no indicator of future performance. And as always, we make these webinars interactive, so please feel free to ask questions by typing them where you see the orange arrow, and we will answer them more towards the end of the webinar. But if we are talking about a particular topic that you like, please jump in and ask a question. We'll be happy to help. So let's get into it. First thing first, a bit of sense of humor, never went astray. So look, the old movie Titanic, I think this is an old saying from that, never let go, Jack. And look, this is pretty much true of the current markets because we are in stormy waters, and we don't want to let go of our favorite stocks, but it is time to make some changes if you haven't done them already. But Cheyenne, this is one of your favorite movies, Titanic, isn't it?
Yes, correct. And all I can say to all the members out there named Jack, hold on to your stocks and never let go.
Absolutely. So look, let's talk about the markets first, because today what we want to do is provide you a plan, and we're going to give you lots of information. We've done a lot of research, and this webinar is designed to give you some ideas on what you can do in this market. So let's have a look at the first macro economic background that we're facing at the moment. So first things first, world markets are currently in a downward trend. There's no doubt about that. Led by the US markets, which are down anything from 13%, which is Dow Jones year on year. And of course, the NASDAQ tech heavy index is down close to 25% so far. And if you look at the Asian markets, yeah, pretty much the same, anything from 10 to 20%. And the Australian market is now also down between 10 and 11% so far. If you look at the year so far, the S&P 500 has had one of the worst starts to the year, and also one of the most volatile years in history. And you can look at here the top 15 volatile years we've had from 1930s, when we had the Great Depression, to 2020, which was the third most volatile year, where we all know about that in recent memory. And then, of course, a lot of big events from dot-com crash to GFC, etc. So 2022 is shaping to be another year which is going to be written in history to be one of the most volatile years, thanks to a lot of factors, including inflation, rising rates, the war in Ukraine, and the list goes on. So let's have a look at what's causing the recent volatility. Clearly, the old saying is don't fight the Fed has come true this year, as they have really come alive in terms of raising rates. And the last 4 or 5 months in a row, we've seen huge rate hikes, which is, causing stress in the equity markets, crypto markets, and property markets for that matter. Let's have a look at the S&P 500. So this chart here shows you quite a few things if you really look at it closely. First thing first, yeah, we've seen the big rise from 2020 and January 22 was the peak. And you can clearly see that since then we've been in a downtrend. Now, typical in a downtrend, we see some few bounces off the lows. So we've seen the first bounce around March, April, then we've seen the June lows, and then we've tried to get back up, and we've been knocked back from resistance twice, and now we've come back down again in September. Now, currently we're sitting on this big support level around 3,600 points, and the market is trying to hold on to this. So only two scenarios will happen. One, if the market holds on and does a little bit of bounce from here, we're going to see a bit of relief. It can happen anything from 5 to 10 to 15% jump. And we saw last time around from June lows, we saw nearly a 20% rise in the markets before we saw a further fall. So that's probable if this support line can hold. And on the other hand, if it breaks, then we're going to most likely go down to test the next level of resistance, which is around 3,400, or I should say support around 3,400 points. That's the S&P 500. Also, you need to keep a close eye on the RSI index, which is typically used by a lot of technical analysts. And you can see there back in August, when we hit the resistance line, the RSI was looking overbought, and then we saw a drop in the markets. Currently, it's looking the reverse. It looks oversold, and it wouldn't surprise us if we saw a bit of relief in the markets in the coming days ahead, and that could present some opportunities of improvement in your portfolio. But look, that's the current picture. The long story is we are expecting further downside risks in the coming months as the inflation is sticky, the interest rates remain high, and the volatility is most likely to continue for the next few months. So you need to stay calm, you need to have a plan, and we are going to discuss that in a moment. Now, part of the Fat Profits research is we look at a lot of things from history, and history can, although it has a knack of repeating itself, but it also gives us a lot of lessons. So if you look at this chart, and I think you're going to find this very interesting, I certainly do. This looking at from 2000 till 2022, so last 22 years of data. And what this shows you is all these red points that we have marked on this chart shows you the times when the S&P 500, most of the stocks were trading below their 50-day moving average. And these are pure stats. And what this shows you here right below, where you see the red dots, when the S&P 500, all the 500 companies there are very close to less than 50-day moving average. So nearly all of them, you can see very close to zero, where majority of the stocks have pretty much come to capitulation mode, and they are trading below their 50-day moving average. Now, every single time that has happened, the markets have actually bounced from that point. And you can see here, back in 2002, there was a pretty strong correction, and the markets had dropped. We saw that. Of course, we all remember 2008, 2009. We saw about 3 or 4 times this had happened, and the markets jumped from following that. 2012, 2015 was another drop in the markets, and then followed by 2018, and of course 2020 was a big one. Now recently we've seen a big drop in the markets, and currently this is where we are at again, and we're very close to zero. Now you want to see some stats? Let's have a look at these. Now in the last 22 years, out of 17 times this has happened, 15 times the markets have bounced following that event, and the average return in those 6 months following that has been 16% in the S&P 500. So only 2 times this has continued to go on and become negative following that, but 15 times. So that's a success rate of about 88%. So, you know, it gives you an indication of what is likely to happen. We're not saying that it's guaranteed, but the likelihood of that happening are pretty strong. Having said that, let's look at another stat, volatility index, VIX. Now this shows you the gauge of fear, you know, grabbing the market. So if you look at this here, we're showing you a bit of a median line, which is around 47. Now this is obviously from 0 to 100. And if you look at 1998, 2002, 2008, and so on, every time the volatility index has crossed the 47 mark, we have seen, you know, that is the bottom in the market. So everyone's now talking about when are we going to see the bottom? And if you look at recent times in 2020, yes, volatility index spiked well and truly past 47. We saw that in 2018. And of course, in 2008, when it was really at its peak. So currently, we're sitting at around 30, the volatility index. So that really shows that even though the markets are falling, but we haven't seen the VIX rise near enough yet. And you might remember Angus talking about this in his daily fact chat lately, and he's looking for the volatility index to rise above 45 for us to say, okay, we've now seen capitulation, and now we've most likely seen the worst of the sell-off. And that's the time where we will be most likely looking to buy stocks. So if you're sitting on cash, that's another indicator you need to keep an eye on. And the last one, which is very important, is earnings. And now everyone's looking at earnings. And this chart, while it looks busy, I'll try to break it down for you. Shows you, the blue line shows you the 1-year treasury yield, and the black line shows the earnings per share. Now, when the treasury yield, the 1-year yield rises, if you look at 2003, and you will notice that the 1-year treasury yield was rising here, and the earnings per share were falling, and you can see that there. So there is a correlation. If the yields start to rise, earnings start to fall. And you can then see there's a lag, and usually there is a 17 months lag. What that means is if the yields have risen, it takes about 17 months on an average for the earnings per share to really start to fall. And you will notice that here, the earnings per share started falling. If you look at, bring that forward to today, you notice that recently the earnings per share in 2022 were really at the highest level they have been in the last 40 years. And that was obviously unsustainable. Now that started to fall, and the treasury yields have started to rise. In our opinion, this is now going to be the next event where the earnings per share will continue to drop further as the treasury yields continue to rise. And once we hit that bottom, which is a bit of a lag, it takes a few months for all this to play out, then we're going to see the bottom. And this chart is an absolute easy way to understand this. If you look at the S&P 500 once again, and the orange line is the federal funds rate. And you notice, and then in 2005, the Federal Reserve started raising rates. And as the rates continue to rise, the markets continue to rise as well, which is a bit different. And while the rates were high for a couple of years, and they felt the economy could handle it, eventually there was the housing market bubble, which popped, and then all this came crashing down. And as the markets started falling, the Federal Reserve started cutting rates, and all this took about 18 months to unfold before we hit the absolute bottom. Now, if you look at fast forward that to today, you will notice that Federal Reserve have raised rates once again. However, they're nowhere near the 2007 levels just yet, but the likelihood of them going higher is pretty strong over the next at least 3 to 6 months. So as this continues, the market is falling. So we think the earnings will still continue to drop, and the forecast will be on the downside. but that's got a few months to play out. So if someone's telling you the bottom is already in, the stats or the data will tell you otherwise. So we go by a data, not by a hunch or a gut feel. So the data is telling you there's still a few more months for all this to play out and the bottom to be firmly in before we can confirm this. And this is the final piece of the puzzle which will confirm this. And you can see the US corporate earnings back in 2008, the orange line really fell before they started to go back up from 2009 onwards. We saw the same thing happen in 2020. The earnings really took a dive before they started to rise again. We're now seeing that play out again, but still, in our opinion, that has got a bit more to go before we hit the bottom, and that takes a few more months of downward revisions. And the last one here is another example of the earnings, which really, if you break it down, earnings is the driver for the share markets, for the company and for the index. If earnings go down, share market follows. You can clearly see that in 2008 and 9. And when the earnings start to rise, the share markets follow. And that's just a classic example. So we're going to keep a very close eye on this. And here's a snapshot from Goldman Sachs, who recently announced that until the economy either enters a clear recession or shows sustained signs of progress on inflation, the pressure for tighter financial conditions is unlikely to abate, and periods of relief are unlikely to be sustained. So this just underlines what we have just been saying as well. So hopefully you find this data, which will take a lot of time to prepare to make it easier for you. Hopefully you're finding this useful. And if you are, please let us know and send us some feedback, and we will appreciate that. Now let's look at corporate earnings. Now the canary in the coal mine, which provides the early warning signs, recently also took place, where you saw the announcement. And if you haven't, and this is probably going to come as a bit of a shock to you, is FedEx recently announced a downgrade of the earnings. And the share price took a big dive. You can see that on the right-hand side, dropped about 21% on the day. And that really shook the markets on that given day, because they said a slowdown in the global economy has to be blamed, and they're looking at reduced profits and reduced demand. And that is really something which is important for you to keep an eye on, because these are the canaries in the coal mine. Now that brings us to what we should do. And recently, as most of you would be aware, Angus Geddes, our CEO, has been talking about raising cash levels over the last few months. And Ash, maybe we'll go to you now. Tell us about what Angus has been saying for the last few months, and what's his current position in the market in terms of cash?
So firstly, Angus has constantly been advising members of staying a bit more towards cash heavy if they can. He himself is sitting on 25 to 30% in cash in his Aussie portfolio. And he also mentioned in one of his dailies recently that he's moved to 60 to 70% in cash in his global macro portfolio. If you could take us to the next page, Roger. You can see it here. He has mentioned that the volatility index is on the cusp of breaking out, according to us. The markets should be bracing for further volatility directly ahead. He continues to believe that S&P 500 is in the midst of another leg down. And even today, we saw in the daily that S&P 500 has closed just below the June lows today, and it looks like it's at the risk of further downside extension towards 6,400.
Yeah, absolutely. So you're right. That's something
Off to you, Roger.
Yeah, no, that's fine. Thanks, Ash. This is something to keep an eye on. And look, the daily fact chats are providing that information. So hopefully you have also raised your cash levels to something similar to Angus. And if you have, you're going to be pretty comfortable with that position. Cheyenne, we've also made some changes recently to the daily fact chat. Tell us what brought that about.
So we've actually introduced the first look of our daily fact chat this week. Now it comes out as bullet points which makes it much more user-friendly for our members to have a look through, pretty much go through the bullet points, see what interests them in reading further. So it's given them a breakdown of the stocks that we've discussed as well in there. So we have actually been talking about making changes to our services to make or hear out our members with the surveys that they've done. And this is one of the first looks that we've introduced this week.
Yeah, no, that's looking good. So far we've received the feedback that that's pretty handy, so you can understand what are the key items in that daily fact chat, which is an important source. Now, part of that is gold, and Cheyenne, there's no surprise that, look, gold is down because US dollar is up, but Angus has been talking a fair amount about gold and what people should do, and certainly not give up on that just yet.
Correct. And I mean, a lot of our members that's been with Fat Profits for years now, and I've been with Fat Profits for a very long time, we all know that Angus has been bullish on gold from day one. So obviously it's a very good time to have a look at these stocks. He thinks gold stocks are good to get into for more of a mid to long term, obviously. So we've got a lot of stocks in our portfolio that we're holding on to at the moment. So we're still quite bullish, and he's still quite bullish on them.
Yes, and you're going to find a lot of that information, not only in the daily emails, but of course in our reports and our website as well. So look, if you're holding on to gold, let's talk about that just briefly. Most of you would be aware, look, it is a little bit frustrating because that's one part of the portfolio which is down, but you know the reasons behind that. And if you look at this chart here, this is a sort of a longer term chart over the last 4 or 5 years. Yes, the long-term trend was pretty good. We've hit twice, we've hit $2,000 an ounce, which you can see right there. And recently, in the last 6 months or so, gold has really come off. However, if you really compare that to the RSI levels right at the bottom, which is the relative strength index, it clearly looks oversold, currently around 34. And that's a sign of potential things to come. Now, one thing we would suggest is if you look at the US dollar index, and this is a very long-term chart of the US dollar, right from 2000 till today. Previously, we've seen it at all-time highs of 120. Now, in the recent past, it's gone from 88.90 to 111, so that's a steep rise of around 20%. And that's put a lot of pressure on commodities in general, but gold and precious metals in particular. And that's not helping the US companies either, especially the exporters who get their earnings in US dollar terms. So at the moment, the way we see this is the next few months, potentially till the end of this year, early next year, the US dollar is likely to remain reasonably high. It could even test the previous highs of 120, where it's going to face a lot of resistance. And we do feel that once the markets hit the bottom over the coming months, then the money will come out of the US dollar and it's going to start to fall backwards. And that's going to provide a real tailwind to gold. And we expect this to retest the previous highs of 2,000 US dollars an ounce. And you work that out. Once it goes back to those levels, a lot of your gold stocks are going to have a very strong run. So our advice to you is to stay patient, not give up and make irrational decision now because of loss of patience. In fact, if you don't hold enough gold, we do advise that these are the times to actually buy and accumulate on the dips, and you're going to be rewarded most likely sometime next year. Now, talking about the mighty dollar, well, here we go. You can clearly see the stats here. The Dixie DXY, that's up nearly 20% year to date versus the other currencies. So that's no surprise. But if you look at the hard commodities, gold, on the other hand, is actually only down 4.5% year on year. So when you compare that to 20% rise in the US dollar, it's actually, you can say, it's held up better. It could be worse. If it was down 20%, it could be down to 1,400 US dollars an ounce. So on that level, we think, look, it's actually held up well, which is a good sign of things to come. Lithium, on the other hand, wow, that's really been the standout. Lithium has done really well. Now, Ash, one of the other things we're also suggesting to members is to stay defensive. Can you expand on that, please?
Now, look, one thing that we've constantly advised members is to try and expose yourself to stocks that wouldn't be as impacted by the market as speculatives would be. Angus has been saying it's still too early to deploy any cash. We recommend sit on at least 25% cash in a standard portfolio. And he believes S&P is still likely to remain under pressure and yet to form an important bottom. If you are still unable to purely do that, if you could take us to the next slide, Roger. We have been advising members to at least continue to hold on to some of the defensive stocks they're holding, like the ones we've recommended included Telstra, Medibank, the banks, APA, Spark New Zealand. If you've got enough exposure to them, you can still ride the wave and come out looking happy.
Yeah.
Now, as you guys can see, based on Angus's advice, our analysts have done the same thing. They've started moving a lot of our stock recommendations to a hold over the last couple of weeks. Roughly at this stage, we're currently holding at least 30 stocks in our portfolio with the hold recommendations, waiting for better and better opportunities to buy. And when we do see those opportunities coming in, we will advise our members to take action. But at this stage, continue to hold, sit on your cash, and we'll let you know when it's time to take the opportunities up.
Yeah, very good, Ash. Thank you. So yes, look, we moved a lot of them from buy to a hold. We do recommend stay away from highly speculative stocks in this market because you could really be smashed around. And, you know, defensive stocks are good, high yielding stocks are good. And outside of that, cash is very important for the other side. Now, one of the important parts of our service, Cheyenne, is our quarterly income report, which gets updated. And recently we updated that on the 27th of September. Can you tell us a little bit more about this income portfolio?
Yep, just as you said, Roger, it gets updated every quarter. And if you move us to the next slide, I can give you an update. So pretty much we've been running this income portfolio for 10 years, over 10 years, and it's been returning 13.5% for us year to year. We've got obviously a diversification of stocks on the left. We've got it in financials, industrials, property. So obviously the primary goal with this basket of stocks is to provide our members with diversification and to obviously give them dividends and growth as well. So the portfolio has been doing quite well. It gets updated so members can refer to it whenever they want, create a watch list and have a look at the stocks.
Yeah, very good. So yeah, this has got about 22 stocks at the moment. And look, each quarter the performance of course changes. Most of you would remember a quarter ago this was trading at around 17% annual returns. Obviously in the last quarter the markets have punished everything. But look, it's still down only about 3.5% in the last quarter, which is not bad compared to the market, which is down about 10%. So again, defensive nature of these companies are holding up all right. And we do think on the other side of this, when this starts to ramp up again, we're going to see this build up. But Cheyenne, this screenshot here shows the dividend yield, which is very important for our self-funded investors. Can you run us through the dividend component of this portfolio?
Now, starting from the right, we'll go from the right. So you can see that we've got franking on there. So it shows which ones are fully franked and which ones are not. So we can see a lot of them 100%. So mainly a lot of them are fully franked. They're also, with the gross yield, they're actually on track to return 6.9% for year 2023. And net yield is on track for 5.7 for 2023 as well.
Yeah, no, that's the, I think the bottom line is people what looking for is net yield. Of course, franking credits are important as well. But look, you can certainly pick the ones where you really think you're going to get a better yield than 6 or 7%. I mean, there's a couple of good examples there. But look, instead of us showing them here, I think a lot of members want to know where they can find this, because some members are not exactly sure where to find this. So can we take them into the website and show them where this is?
So Roger, if you could please scroll down And in this menu, you can see the second last option above live weekly research webcast is latest income report. When you click on that, you can actually find all of our income reports we've published over the last year or so. And every time it gets updated, you see the latest one on top. If you click on read more, Roger, you can see the whole report is right here for you to see. It goes very well into detail with all our sectors, the stocks we're covering, where we see the markets heading. For members, I always say this: if you are short on time, if you can't read the whole thing right now, jump to these tables. As you can see in this income stocks performance table that we just discussed, just make sure you note any stock that has an asterisk next to it. It means that we have sold it and we don't have it in our income portfolio anymore. It's included in here to see what kind of performance we've had in the past. And if you scroll further down, Roger, here is our current income stocks composition. These are the stocks we're currently holding that Roger and Cheyenne have discussed already. Now, guys, now that we're on the website already, I do want to show our members a few more little things that we always get asked where to find. So when you are looking at these stocks and you can't find where's the latest report on them, just above the daily fat chat, on the right hand side, we have a search stocks and reports bar. So if you ever want to see whether we cover a stock or not, or what the latest report is, you can search the full name of the stock. Make sure you're searching the full name and not the ticker. If you just go with the stock code, you won't get any results. If you click on search, Roger, thank you. You'll see the absolute latest report will come on top with all the further following reports from the past next to it. This way you can go and read individual ones. Now, if you could please take us back. Perfect, that's the page we wanted. If you scroll further down, Roger.
Oops.
That's okay. Scroll further down, please. Yep, you can go next and you can all, yep, perfect. You can go all the way back to the beginning and find our first report, when we started covering it, and which fat charts we've mentioned it in. Now, if you could please take us to members home.
Yep.
Excellent. Another thing I get asked pretty much every single week by our members is where can they find websites, webinar recordings. So the last option that you see here, live research webcast, a hidden gem here is all the recordings we've ever published of our webinars. So if you scroll down, all the latest webinars are updated right on top. You can see the recent special webinar we did, Turbulence Ahead, and the weekly webinars next to it. All you need to do is expand the page, press play, and you're good to go. This way you won't miss out on any recordings. If they get lost in your inbox, you don't have to go find them. Now scroll further up, please. Guys, if you also want to receive live links for the live webinars, and if you aren't receiving them, just here on the right hand side, if you click on register now, you can put your first name, last name, and email address, and you'll start receiving links to join our webinars live. Now, perfect. Thank you, that's it, and click register.
So Ash, do I have to, if I'm a client, do I have to register my email every week?
No, you only have to do it once. We can schedule our webinars for a whole year at a time. So every January, we send out an email telling members, please register yourself for this year's webinar, and then you're set for the year. You won't have to do it again.
Thank you.
Now, if you take us back to members home, thanks, Roger. Everybody already knows what our latest weekly report and new recommendations are, but a lot of times, guys, I always get asked where to find stocks that haven't been updated in a while, or what all stocks we currently hold in our portfolio. So if you go to our Fat Profits portfolio page, you can actually see every single stock we currently cover in our Oz Equities portfolio, including the first report on them and the absolute latest one. It also shows what our current action on those stocks is, including a buy, a hold, or a sell half if there may be further below. But please make sure you check this. You see you are well diversified within the stocks that you're getting recommendations from us on. And if there's anything you need help with, feel free to get in touch, and we're here to help you out. Over to you, Roger.
Excellent. Thank you for that, Ash. That really helps. Look, we're getting some questions, but I'll get to them in a moment. But in fact, one of them just commented, I'll just go back to the presentation. Margaret just commented saying, look, thank you for showing me where the webinar recordings are. Sometimes I miss them. So not a problem, Margaret. We got another comment from John saying that he's been using Angus's direction to raise about 35% cash. So he's gone a bit more than some of the other members. So 35% cash at the moment. He's feeling quite comfortable. So that's good to hear, John. Hopefully most of you listening in today have taken some sort of action and raised cash. So let's talk about raising cash now. You know, of course, in volatile markets, you do need to have a plan. And one of those which we talked about is, you know, look, the old saying, if you fail to plan, certainly plan to fail. And in this market, the plan absolutely is to move some of your stocks around. And we can't just sit there and hold on to everything we've got and pray that they'll come good, because some of them won't. So we just have to be proactive as an investor. And as we said a few months ago, that this is the time to make a change. So the change is this. This is a typical spread of investment. So typically people have a small amount in cash, small amount in fixed interest, and then maybe a property or two, and something in shares, of course, and they might have other investments as well, i.e. cryptos or who knows what else. But now that the market is changing, people have started to move. And in fact, some of them moved, like John, for example, where the cash levels have been raised than a typical low level. So people are now sitting on a lot of cash, including fund managers, institutional players, people like Angus, for example. Fixed interest is now starting to go up as well, because the term deposits are starting to finally look a little bit appealing, but still well below inflation. Property is going down, so people are now starting to sell and move away from property shares. And then, of course, equities, you have to be careful. So you must be in defensive stocks in this market, at least for a while, and then make some changes. So that's the shift in the pendulum, if you like, that we are suggesting. If you haven't already done so, we would certainly look at that. So first sector to look at is financials. And look, we all know what's going on in the financial space. The rising rates will help the banks in the long term. And this is a look at the long-term view of the financial index. Now you can see here, we're trading in a bit of a sideways pattern. We've hit all-time highs back in 2014. We've hit all-time lows back in 2020, and now we're trading in between. But that's not bad, because in this volatile market, at least the financial index is holding pretty well and still paying healthy dividends. So our suggestion is stay on and hold on to your financial companies. And one of them, as an example, is NAB, which is one of the better performers out of the big four. Their loan book is currently in good health. Dividends are well above 6%, and they're still sticking around $29, $30 a share. And anyone who's bought it in the last couple of years at any stage, unless you bought it at 32, you'd be pretty happy. So all in all, look, NAB we've maintained that rating, and we're happy to just continue to hold that as an example. But Ash, another sector that we are suggesting for people to look at if they haven't is soft commodities.
And I would say, Roger, Angus has been pointing these out for quite a while, that he does see soft commodities doing really, really well in the long term. While currently we are recommending people to not buy any stocks and continue to hold what they have. If you are holding, be it Elders, New Farm, or Australian Agriculture Company in your portfolio, continue to hold on to it. If you're not, add them to your watch lists. Continue to track them, and when we do see an opportunity to get into them, we'll let you know.
Absolutely. And here's something. Well, if you're enjoying this so far, I think you're gonna like this part of the webinar today, because we've put a lot of effort into preparing these topics. Hopefully, getting some good value from what we're discussing so far. And here's another example for you to look at. And this is just a portfolio we recently looked at, and how to position and move the stocks around. And we'll give you a couple of examples now. So this is just a snapshot of some of the stocks, and this particular investor has more stocks in their portfolio. And look, if you look at the kind of companies from top to bottom, you're going to see Allchem, which has obviously been a standout. This investor has quite a bit of capital in there compared to some of the others. For example, banks, if you look at ANZ, ANZ is actually on the lighter side versus a mining company. So this is a bit of a growth angle. But then you look at BHP, they've got a reasonable sum there versus some of the others like APA, for example. CBA is obviously quite a big holding for them, and CSL is clearly the largest. So if you look at the spread, I mean, yeah, you've got some gold stocks like Evolution, smaller holding, but that's all right. But you can see some of the companies that this investor has. The spread is probably something you want to look at, is make sure you're not holding too much. For example, AKE, that's probably on the high side. Maybe because they got in early around $2-3 a share, and it's gone to 14, 15. So that's probably done that. However, it's important in this market, in our view, is to lock in some of the profits, have a look at your weightings, and don't have an exposure on something which is pretty heavy, pretty high at the moment, and just reduce the risk, raise the cash levels. And we did suggest a few to this particular investor to just move some of the stocks around and get the balance right, especially raising the cash levels. And here's an example of another portfolio from a different member that we recently looked at. And again, you're going to see something similar, where AKE seems to be in a lot of members' portfolios. In this case, they got in pretty early at $2.40. At the time of this portfolio, when we looked at it, was trading at $14.20. Well, it had a huge run, and clearly is the biggest holding in this investor's portfolio by a long shot. So that's something to keep an eye on, and if the statistics are showing that that's something you need to lighten, then yes, that's something to consider. But overall, this portfolio is quite healthy, if I might add, because it has a good spread of financials, mining companies. You can see the 4 in red, they're all the gold companies. But you look at gold stocks, you know, the weighting is 1, 5, 6. So if you look at about 12% of the total portfolio is in gold, so that's reasonable. We've seen some more or less in the recent past. But then you look at down at the bottom, Woodside, that's nearly 10% of the portfolio, maybe a bit on the higher side, but the others are reasonably well spread, you know, 5% or less. And you've got some defensive stocks in there as well, like Spark or Treasury Wines. You know, you've got the banks, etc. So this portfolio we think is quite on the mark. It's got about 20 stocks, and that's a healthy looking portfolio. Yes, up around 42%, and you know, sitting pretty well. So what we can do for you is you might remember recently we introduced a new service, which is an upgrade to your current service, is we can offer you portfolio reviews where our team can look at your current holdings and we can provide you general advice on how to restructure that a little bit. And if you're open-minded in this volatile market to raise the cash levels and improve your returns in a year or two from now, well, now is the time to look at it. So Cheyenne, over to you. You've been with Fat Profits for 12 years out of 22 years, and we're now coming up to this big milestone. So what are we doing at Fat Profits?
22, it's a very, very long time, Rog. So what we're doing is based on our members and the relationship that we've had with them over the years and the service upgrades that we're doing just before we roll out our 22nd anniversary offers next month, because we're celebrating it in October. We're actually giving our long-term members an opportunity to secure these discounted loyalty discounts that we're running at the moment. So because of inflation and the service upgrades that we've done, the new rates have initially gone up on the website. So there has actually been some new prices that we've introduced, but we're actually giving up to 50% off today. And obviously we've got different bundles available as well, because it doesn't matter how many years you've got left on your membership. If you're actually just signed up with Fat Profits, we're able to provide you with some value if you do decide to come on board with us today.
Okay, so typically I'll put that up now on your screen. So if you're interested in locking in a cheaper rate and saving yourself money before our prices do go up, because look, one of the things in the last 4 years, some of you might remember, we have not changed our prices for the last 4 years, which is actually a record. We've done that since 2000 gradually, but because of COVID lockdowns, we haven't been able to. Have we, Cheyenne?
Yeah, and plus we were also thinking about doing it 2 years ago, Rog, but because with COVID and everything, that's actually been put off as well. So now we're actually, it's already gone up on the website with the new rates.
Yeah, so essentially this is an opportunity where you can get a discounted renewal, and we can add some time to your existing account, and you can save yourself from paying higher fees. Also, if you're interested in the portfolio review service, which we've just recently introduced, you can show us your interest there, and we can work out a deal for you where we can offer you a very good price, and more importantly, add value to your investment and give you the guidance in this market. Or if you're interested in both, we can work out a bundle where we can do both for you. So you can select the third option if you want to do both. Or if you're unsure and you want to have a chat with someone, you can choose the fourth option, and we can get back in touch with you. Now, Cheyenne, we're getting a few questions here. So maybe you want to just cover a few. In fact, one of them is from, let me just have a quick look here. Jonathan says he's been with us for about 12 years. Oh, good on you, Jonathan. And he's saying...
we both joined at the same time, I guess, Jonathan.
Sounds like it. So he's saying, look, firstly, well done on the webinar. I found that really informative. Thank you for putting the effort in informing us. Secondly, he's saying he's got about 2 or 3 years, he's not exactly sure, 2 or 3 years left on his current service. So what happens if he takes advantage of this loyalty promotion, Cheyenne?
Well, the time that he has left on his membership, we don't take that away from him. It just gets upgraded to the new service. So everyone in this webinar or members that's got a couple of years to run can take advantage of it, because we're giving our members an opportunity to upgrade now before the new rates hit. So it's a very good time if you do see yourself in the markets for more of a mid to long term, holding on to a portfolio for the long run, then this is the optimum time to take advantage of these offers, because obviously we're turning 22. We don't run these offers all year round, so it's a very good time to take advantage of these offers. And thanks, Jonathan, for your feedback. Obviously it's my first webinar, so a bit nervous, but I'm sure I'll get there someday. It just took me 12 years to do my first webinar, so another 12 years, I think I should be all right.
No, you've done well, Cheyenne. Look, another question we have from this is from Karen. She's saying, I recently joined Fat Profits only about 9 months ago, and I'm finding the service as a good source of reliable analysis, and it's helping me understand the markets. So thank you for your information. Her question is more about the portfolio review. So she's saying, I have a self-managed super fund and also run a personal portfolio. So if I took advantage of this service where you're offering portfolio reviews, what sort of price are we looking at?
Well, in regards to the price, we tailor it according to our clients' needs. So the best thing to do is we'll get one of the account managers to get in contact, and according to what you're looking for and the portfolio review, they can cater a price according to what you're looking for.
Yep, great. Okay, so and keep in mind, Karen, these are tax deductible. So we will issue a tax invoice either under your super fund name or your personal name, whatever you prefer, and most of our members use that as a tax deduction, so you should be able to do that, but of course speak to your accountant for it. Next up, we've got a comment actually from David. He's saying, oh, this is one of the best webinars I've heard from Fat Profits in a long time. and I especially enjoy a bit of a change from hearing from some ladies for a change as well. So.
I was just about to say that. It's because it's the girls doing the webinars today, I guess.
I guess the members love us the most, Roger. No wonder they call and ask for us first.
Yes, sure. All good, all good. Thank you for the feedback. And look, the final one here is just a question on the markets. So this is from, let me read that name, Keisha. So I hope I'm pronouncing that right. So Keisha's saying about the markets is, I am sitting on cash, just like Angus has been suggesting. Will Fat Profits be providing the analysis on when we hit the bottom or close to it? So look, Keisha, I'll answer that for you. Absolutely. Look, we're all waiting and watching the markets very closely, and please stay tuned, stick to the plan, and when the market does hit the bottom or close to it, we might not get the absolute bottom, but we will certainly look at all the data coming in, and if we get it right, we will make some money on the other side of this. So please stay tuned. We're glad that you're following the advice, and hopefully you found the information useful. So on that note, I'm going to close this poll now. I think we've got a lot of registrations today, so thank you for your interest, and we will get back to you with the information and try and work out something to help you. But other than that, look, my name's Roger. Hopefully you found the information useful in these stormy waters, and hopefully we can help assist. If you have any questions, please email info@fatprofits.com.au, or you can call us on the main line 1300 88 1177, and I'll pass it on to the girls to say the final words. So over to you, Ash, first.
We'll see you in the next webinar, everyone, and I really look forward to speaking to all my members next week.
Thank you, Ash.
And just remember, guys, we're on publishing break next week. So thanks for having me on this first webinar. A bit nervous, like I said earlier, but I look forward to speaking to you guys.
Excellent. Stay tuned and happy investing. Thank you.